Good day. My name is Epish Takasi, and I'm happy to be moderating this session. I'm a consultant, a senior consultant specializing in financial inclusion, and I have the pleasure of directing your questions to Kathleen, who is our speaker today. Please do post your questions in the question and answers. You'll find the box at the bottom of your screen, and we'll also be asking you questions via the poll. But before we start, I'd like to give you a little bit more information about Kathleen. Kathleen Tobin is a global gender and financial inclusion specialist with private and public sector experience in consumer insight, solution development, and communication tailored to women. She recently served as a lead author on the IFC FMO study, Non-Financial Services, the Key to Unlocking the Growth of Women-Led Small and Medium Enterprises for Banks. She is currently communication leads on multiple projects in Sub-Saharan Africa and the gender lead on financial inclusion initiatives targeting MSMEs in several regions. As a director, consumer insights and engagement at Women's World Banking, Kathleen led work with financial institutions, telcos, and other entities to deepen their understanding of hard-to-reach client segments and use the insights to develop compelling, sustainable financial and non-financial solutions. Kathleen also designed and led a range of comprehensive marketing and branding efforts for leading consumer companies. She holds an MBA from Cornell University's Johnson Graduate School of Management. Kathleen, you're welcome. Today we are here to talk about gender finance, which is a very important topic. I think it's very common now in the financial sector in Africa. Before we do that, we would want to know who is in attendance. So right now you should be able to see a poll asking you a few questions. Please do go to the poll section and answer whether you are from a commercial bank, microfinance, development financial institutions, NGO, regulator, or MSME. Do let us know your gender. Tell us as well whether your institution already has a gender strategy for the clients. And also we're interested in knowing why you're here today. Is it because you're responsible for your institution's gender strategy or policy? Or you're working on your institution's gender initiative and would like to learn a little bit more about it, or you're interested in learning about gender finance in general, or maybe you were told by your boss to join, or maybe you're here for networking. Do let us know why you are here so that we can adjust the content to your needs. Giving you a few more seconds.
So this first poll is, what type of organization do you represent?
Right.
So we'll close this one. See who we have in the room.
So I'm hoping that you found the poll section and that you've been able to share with us. We are getting the results. We'll be continuing in a couple of seconds.
So everyone, please go to the poll option on the app. There is a poll option. There's chat, there's Q&A, and there are polls. Please go to the poll and answer the question of what type of organization you represent, so we'll know who is in the room with us.
It's very important so that we can adjust the content of the discussion so that everybody gets the best out of it. Right, thank you very much for voting. As we can see we have mostly with us microfinance institutions, as well as development financial institutions and NGOs, but as well regulators. So it's a mix of people from different backgrounds, Kathleen. Next, we would want to know your gender. Do the same exercise again. Please use the button at the button at the bottom of your screen and let us know your gender. Just collecting the answers, and then we will be moving to the next question, which will be whether your institution has a strategy. So just in a few seconds, just closing the second question. As a reminder, from both the French and the English poll, we found out that most people here are from microfinance institutions, as well as development financial institutions and regulators. And this result applies both for the French section of the poll and the English section of the poll. Okay, from the result of the gender, it's interesting to see that 80% of people who entered the poll are women and 20% are men. We'll take the next one. Does your institution have a gender strategy for your clients yet or not yet? Do answer so that we can build on that later on. Okay, so we are expecting the answer for the next one, whether the institution has a gender strategy. It's interesting to see that most people attending here are women, especially on the English side of the poll. However, on the French section of the poll, it's mostly men. Interesting. So it's a mix of audience. Does your institution have a gender strategy? And I think after this question of the poll, Kathleen, I suggest we move to the core of the topic.
Sure.
So just before we get the results, I can already anticipate, right? So what we see is that on the French side of the poll, 50% of people responding do have a gender strategy for clients already. And on the English side, 67%. Okay, that's quite interesting. Mm-hmm. Kathleen, this topic, we hear it more and more. Why are more financial institutions focusing on gender finance? What is it about it? Is it a fashion? What can you tell us about it?
Yes, well, I hope it's not a passing fashion, because the main reason that institutions are beginning to focus more on gender is that the demand is there. There's a business case. So to give one example, women-led MSMEs in developing countries need 1.6 trillion US dollars more in credit for their businesses than they've been able to borrow. And women also underestimate often the amount of financing that they need to grow their businesses. So there's untapped demand there, there's opportunity. We also are seeing, have been seeing for a number of years, that women are a growth segment for financial institutions. So the Financial Alliance for Women's annual member survey, the Financial Alliance for Women is a global network of 60 institutions, financial institutions that are committed to serving women and increasing their service to women. So their annual member survey has shown for 6 years in a row that women are outpacing men within the institutions in that member base in both number of customers and the amount they're borrowing, credit growth every year.
That's amazing.
2014.
That's amazing.
And then the same survey, so the Financial Alliance survey has found year over year that the share of non-performing loans among women-led SMEs was half that of those among male SMEs in 2019. And that's been a consistent figure. I just quoted 2019. So among organizations that focus on serving women with a model like the one that we'll discuss today, there's also lower risk, better repayments. That's a part of it. So in terms of why focus on women, there's a business case, and that's what we're here to go through today.
Right. Okay. So it's not just about CSR; it's also about business case. Well, obviously, the first question we would ask is, what about banks and microfinance institutions that already serve a majority of women clients? There are a lot of them out there, especially microfinance institutions, and the majority of their borrowers, especially for group lending, are women. So what do you say? Can we assume that they are already successful in terms of gender finance, or is there more they can do?
That's an excellent question. And I'm going to see if the polls are working, because before I answer that, I would like to ask the audience, how many of you are with organizations where your clients are already mainly women? And I'm asking because I'm curious to know how you know. Is it because your institution tracks sex disaggregated data, or because you just know? So please answer the poll.
Right, so do go to the poll section. We would really like to know whether in your institution the majority of clients are already women, or whether it's 50-50, or whether you're actually tracking the figures. It's very interesting for us to know. It does make a difference also in terms of where to start in terms of gender strategy. We'll get the results in a few seconds. You have a few more seconds to vote so that we have the right information. Do you know that you do have a majority of women clients because you're tracking sex disaggregated data, or you don't track, but you're pretty sure, or you don't track, and therefore you have to assume? Do let us know. No? Right.
I believe actually the wrong poll is up. So I'm seeing a gender finance poll. So why don't we just skip and go?
Right, okay. Yeah. Okay, so let's assume that part of our audience already has a majority of clients that are women. So we are interested in knowing also about, the impact of sex disaggregated data or not. But we do have results, Kathleen. What we see is that 1/3 of our audience does not have a majority of clients that are women, and they know because they do track sex disaggregated data.
Okay.
And 22% that has sex disaggregated data say that the majority of their clients are women. And then for the rest, the 22% doesn't track the information, and 22% of them are not sure. So we do have a mix. Yes.
Okay, so it's actually interesting to see that the percentage of institutions that are tracking sex disaggregated data seems to be rising. That's great, because sex disaggregated data is really the first step. It's the starting point to knowing what to do next when serving women in terms of how many clients you have, what products they're using, how they're using your products, and where the opportunities are. Advij raised the question about what if we already serve a majority of women? And that's certainly a good question. My my response would be to answer that with a question. So what is the market environment? If an institution serves 100,000 women in a market where there are 2 million underserved women, then there's room to grow, or even 500,000 underserved women, there's room to grow. And institutions can do this by understanding the needs, additional needs of their women clients and potential clients, and finding ways to meet those needs. One example of this is Lead Foundation in Cairo, Egypt. They had, before launching additional products, they had about 140,000 clients. 90% were women. They're a microfinance institution, so primarily giving quite small loans. Research among their clients and potential clients led them to introduce 2 new products. One was a cash flow appraisal product that made higher amounts of credit available to women who had viable cash flows, businesses with cash flows that could support those loans, but did not have collateral. And then there was a second loan that was more tailored to certain types of sectors that women are in. The combination of those 2 loans, after introduction, helped them grow their client base by 40%. So they expanded to almost 200,000 clients, and they increased the proportion of women taking larger loans, those individual larger loans, to 50% of the people taking those loans. So all the while their PAR stayed below 1%. So it's just an example of, how this is possible. And it's really a key of understanding what's needed and figuring out how to deliver it in a way that works for the institution.
Right. Okay. So that means that even if the majority of clients are women, then there's still a lot to be done in terms of being really successful in terms of covering the needs of women entrepreneurs, seeing as the gap in terms of financing is huge.
Yeah, true.
Right. All right. There is also an element of, when talking and reflecting on women and their needs, whether those that have access to loans do have access to bigger loans as well, depending on their constraints. So I would be interested in also hearing about the needs and constraints of women entrepreneurs. What can you tell us about that?
Sure. 2 types of constraints that women, the first is financial, and the second will be non-financial. So looking at financial constraints, access to finance is the big one, right? So they're not able to access the amount of finance that they need. And that's driven by 2 things. The first is limited control over assets. So women are less likely to own property in their name. And even when they own it jointly with somebody else, they're less likely to have access to that property. So the power dynamics, the gender dynamics aren't always equal. And so it can be much more difficult for a woman to post jointly held collateral than it may be for a male counterpart. The other contributor to access to finance constraints is knowledge, right? So women tend to be less familiar with banks. They're less sure about how to begin, how to go about accessing credit. They tend to underestimate how much they need. And so they may not even seek financing because the whole thing can just be something that is unfamiliar and they don't know where to start, and it can be a little scary. So we have a lot of women who don't even seek financing, but who could use it. And the other type of constraints, main sort of category, are the non-financial. And one of these types is really sector choice, and that is very closely linked to access to finance constraints, because the fact that most women don't have collateral means that they are nudged or driven into sectors that don't require collateral. So trade, services, so those are less capital intensive sectors. They can be started with very little, businesses can be, but they're also generally less profitable and more crowded than those sectors that are dominated by men, like manufacturing, mining, IT. So there's a bit of a, this kind of a domino effect here. And then, of course, there are also the gendered barriers. So social norms, which sort of prevent women from fully embracing themselves as, a business identity, laws which prevent women in many countries from participating equally in the economy, time and mobility constraints because they often have family and home responsibilities in addition to business. And these things also mean that she has smaller networks. So if she's not socialized to promote herself as a business person and to promote her business, she's less likely to be out there actively looking for buyers, suppliers, new innovation, those kinds of things. And along that, kind of we're all connected. So then with that, when your networks are smaller, it's harder to find a mentor. You have fewer role models to kind of look up to and say, oh, she did this, so, I can do this too. And then the educational gaps. So science, technology, engineering, and math educational tracks are often what lead to work in sectors that are the highly profitable ones, like manufacturing, mining, IT, those kinds of things. So all of these together kind of conspire to sort of support that 1.6 trillion US dollar finance gap that we mentioned earlier.
Right. So I understand it's a mix of things. It's more complex than just the surface. There are financial and non-financial constraints, also social norms. But interestingly, those constraints sound like problems that can be solved. And more importantly, they don't have anything to do with women entrepreneurs, women SMEs' own capacity or potential. So it's great to hear that. And on the other hand, some of those constraints, we could argue that men could also face challenges that are similar, right? Are we discriminating here?
Yeah. Well, we did have a poll. If we can bring that poll up, I'm happy to try. So I'd like to ask the audience, if financial institutions begin to actively focus on women as customers and serving them well, does that result in discrimination against men? So if we can bring that poll up, right now there's a different poll up. If we can bring that poll up and take a couple of minutes to get the audience's response, that would be great.
Right, so we would like to know, and there's no correct or incorrect answer, we simply want to have your opinion. Do you have the feeling that if you develop a strategy that is focusing on women entrepreneurs, then you are discriminating against men? So do let us know. Yes, no, or you're not sure. It could be that you haven't decided yet as well. So having a gender strategy towards women doing gender finance, can this be considered as discrimination or not? Let us know what you think, and then we can move to the next point and discuss some more elements about gender finance. I hope you can all see the questions. Would focusing on women cause discrimination against men? Yes, no, not sure. Okay, so it's interesting, Kathleen, that 100% of people who responded actually considered that it's not discrimination. So now that we are putting this maybe delicate question of discrimination aside, can we talk about what women actually need to participate equally in the economy? Because in the end, this is what we are talking about. It's not just about finance, it's in general about equal participation in the economy.
Exactly. And when institutions do focus on serving women, basically we're adding things. So adding the things that are on this list. So broadening access to finance and adding opportunities to build knowledge and networks. So in terms of, kind of the key ingredients of a value proposition for women-led MSMEs, the first is access to finance. And that often means alternative collateral options and terms that fit the dynamics of her business and her needs. It could also be personal and business needs together, like school fees, short-term, and business long-term, those kinds of things. Then also education. So how to prepare for and estimate financing needs, how to build business management skills. That includes soft skills, so leadership and negotiation, how to build confidence to face a loan officer, It's an uncharted territory for many women, and it's really that confidence building can make a huge difference. And then also how to improve financial and digital literacy. And then networking opportunities are very important as well. So introducing her to potential buyers, suppliers, and innovation, and then also introducing her to other successful women so that they can share experiences and learn from each other. Equally important are mentors and visible role models. So the adage goes that you cannot be what you cannot see. So if women have no examples around them, it's hard to really believe what they could be. It's hard to see their own potential sometimes. But when you start bringing those role models in, it can really have an impact. And then touching on those time and mobility constraints, whatever can be done to offer a one-stop banking experience, it actually adds a lot of value as well, because women have to shop around. No banks very infrequently go to them with solutions. You have to go to the MFI or go to the bank and say, I need this. They're not coming to the customer to say, oh, we see you also could use this, this, and this, or here we're also offering some networking opportunities. So any way that we can bring this experience together, whether it's under a digital app or through a relationship officer or however, but to kind of bring the offer to her is greatly added value as well.
Right. Pretty interesting, Kathleen. Thank you. So you spoke about financial needs, non-financial needs, education, networking opportunities, mentors, one-stop banking experience, and then as well as digital and self-service solutions. I'm thinking, still linking with the previous reflection and correcting maybe the poll answers. You know, it was 70%, around 70% is the corrected figure when everybody was able to vote. 70% think it's not discrimination, 30% think this might be discrimination. And in the end, what I'm thinking is all those points that you mentioned might be also appealing to male customers. Mm-hmm. What do you say?
I agree. And again, it's because we're not focusing on women to the exclusion of men. We're focusing on women to bring them in and offer broader opportunities, really for all, but some that are tailored to her. So broader access to finance. Some men need education on the points listed here. Networking opportunities benefit everyone. So does coaching and role models and that one-stop convenient experience. So this is really what we're saying is we're adding opportunities to bring them in without trying to exclude anybody. Mm-hmm.
Okay, so now we're really getting into it. I'm sure that most of our audience is highly motivated to go and develop a gender finance strategy if they don't yet have one. But, you know, being an ex-banker, I also know that starting a new strategy with all those points you mentioned could be an expensive exercise. So can you tell us also about, you know, this aspect? Is there really a business case looking at all the points you raised?
It does sound expensive, and it certainly is not free. And so I think this is our final poll. So I'm asking the audience before I answer to say, in your perspective, honestly, what is the main reason to focus on gender? Is it the business case? Is the expense of everything that we've just gone through worth it? Or is it really more of a CSR opportunity? Or are you complying with your government policy, complying with funders? From your perspective, what is the main reason to focus on gender?
We know starting a new strategy, creating new product, new packages might feel that the investment is heavy. We would like to know, for those of you having thought about it already, in your opinion, would it be because there's a business case, so you know it's going to be profitable while helping your clients grow, or is it's more of a CSR element? You want to do good for the community, or are you complying with government policy or other requirements, or maybe you don't know yet? Do let us know what your opinion is. What's the main reason to focus on gender finance? It's a key question. It's really an important question. The answer, the reason has to be clear from the onset. for your strategy to be, successful. Again, as before, there's no right or wrong answer. We simply want to know why you would want to develop a gender strategy. Kathleen, I'm getting some answers. Part of our audience feels that there is a business case, so a financial institution can profit while helping their client grow. And on the other hand, the corporate social responsibility plays a strong role as well in thinking about a new gender strategy. So majority comes in as a profitable thing, and on the other side, the element of corporate social responsibility.
Okay. All right. So those are, of course, two important components. And but let's take a look. And so my focus here, there's, of course, corporate social responsibility is quite valid and important. However, when there's a business case, that tends to be the thing that will motivate a bank or an MFI or another institution to continue with the program after funding has ended or after outside support has ended. So that the business case tends to be the thing that can be continuously presented to senior management as the right thing to do from that perspective for the bank. So what I'd like to take us through today is that there is a positive return on investment with non-financial services. So institutions that offer a combination of financial and non-financial services, like the ones we've just kind of walked through, can yield a profit in 1 to 2 years. It's surprising, and it was surprising to those of us in the study who were analyzing this, but this is what we found across multiple banks in multiple countries. So there are 4 drivers of that return on investment, meaning a return on investment, meaning the full cost of what you're spending on the non-financial services, including, the team that's running it, versus the returns that are coming in through these 4 things. And so the first is increased interest income from loans. So number of loans and loan sizes tend to go up. Increased share of wallet, meaning clients that are participating in non-financial services tend to take additional products, both loan and non-loan products. They tend to save more with the institution, so deposit volume goes up. And then fee income can also go up, and fee income can be driven by the fact that they're taking more products and using more products within the bank, or it could also be fees charged for non-financial services. Loyalty increases as well, and portfolio risk goes down. So we'll look at each of these in a little bit more detail. The first is interest income, and this is often the main contributor to return on investment. And in terms of how to measure this, by sex disaggregated measures, one can look at number of borrowers, average loan size, and loan portfolio value overall within an MSME portfolio. One example here is a bank called BHD Lyon in the Dominican Republic. Their loan portfolio in the 2 years measured 2014 to 2016, after they launched their women-focused proposition called Mujer, their women-led SME loan portfolio grew 26% over those 2 years versus 19% versus the overall portfolio. So women in the portfolio were growing faster. And we saw this across multiple banks as well. Then share of wallet. So share of wallet from, for example, cross-sell. So what we've seen through multiple sources is that women-led SMEs that participate in non-financial services, they have up to 2 additional products per customer versus the overall portfolio. So this finding here was from the IFC, but we've also seen it, Women's World Banking has found that, I believe EBRD has found it, and we've seen it through the individual portfolios that we analyze. So the number of products per customer goes up. And then we also have deposit volume. So in terms of deposit volume, this was a pleasant surprise. We saw through a number of banks that we analyzed, and then also here, this example is from BLC Bank in Lebanon. During the period measured, the rate of deposit growth among women-led MSMEs was 45% higher versus the overall portfolio. So again, it's that participation in the holistic model with the components that we've gone through. And then fee income. So we don't have sex disaggregated data for fee income. I have yet to find a bank that's tracking that. However, we know that when customers take more products, then they're generating more fees for the bank. And one example here on fees charged for NFS, KCB in Kenya, that's Kenya's largest commercial bank in Kenya and the largest SME lender in Kenya. They have a business club that's quite popular, and they charge about $100 per year for membership. And that membership includes access to networking events, training sessions, and then priority treatment in the branch, and also access to payable exposure trips to other countries where members might like to trade and make connections.
Wait, this is amazing, Kathleen. So you're saying that clients are even prepared to pay for those non-financial services. This is amazing.
They are. And it varies by market. And it also, you need a compelling proposition. It needs to be something that people are willing to pay for. KCB has that. And the fees alone, including the salaries they pay the team that manages this, and all the other costs that go into it, their fees cover the costs of their non-financial services, the business club, by 5 times each year. So
amazing.
Yeah, and then they also have the other benefits. Yeah, so these are things to think about in terms of where can you look for revenue, where can you look for the benefits that might come from these programs. There's also loyalty. So non-financial services participants, within a bank or MFI, particularly women, are more loyal. And this example, and ways to measure that actually. So net promoter score is one way that many institutions measure. That's an advocacy score, but you can measure it by segment, customer segment. Client retention rate is measurable. And then also just the share of inactive accounts, by gender and by segment, watching that change over time. The example we have here is from KCB in Kenya. And they very proudly will say in public that during the 3 years after launching their women-led SME proposition, their net promoter score went from -2 to +43. And so hopefully it's continued to increase from there, but it's a huge change.
That is amazing. We really need more concrete examples like this, Kathleen. Thanks for sharing that.
So we do know that women are more, the incidence among women is a bit higher here. There's a bank that we'll go through an example of in a moment. They also found this, as well as a study by Women's World Banking from several years ago found the same thing. So this has been found across multiple kind of sources and studies. Yeah. And then portfolio at risk. So I hear often that women are better repayers. And that's not always the case. If you just give a woman a loan, maybe she'll repay it, maybe she won't. And yes, in many cases, they are better repayers. But in general, not every institution finds that. However, when we look at women that are being targeted with a proposition that is meant to serve them with multiple kind of offers, then they actually do become better repayers. And so just by measuring non-performing loans, the IFC finding is that they're banking on women clients. So they have a program called Banking on Women. Those clients had, the women in the portfolio had a 50% lower NPL than the men. And again, this has been found by the Financial Alliance for Women. It's been found by other institutions, and it's been found by, we noted it in our analysis as well. So these 4 examples, these 4 drivers of ROI can really change the game in terms of, those decisions around what do we offer and should we even do this? And is it the right thing to do? Is it only CSR? There's one example here that I'll take us through. It's a ACBA bank in Armenia. So this is kind of an example that's meant to bring this all together. So We measured their costs on non-financial services between 2016 and 2018. And I'll say what we're looking at now is overall SME portfolio. It's not women only. So overall SME portfolio, ACBA Bank between 2016 and 2018 spent, the little red box, I'll just tell you, their NFS costs were driven by networking, training, and a business portal. So those three things together, they spent X on. What they returned over 2 years, they received 6.5X the benefit in terms of increased loan revenue, increased non-loan cross-sell, increased loyalty, and share of wallet. So it's one example of an institution that went into this. They launched a proposition not knowing that it would be analyzed in this way 2 years later, and that was the finding. And then among women, so they launched a women in business program in 2018. So we did this analysis in 2019. So looking just at the women in business, they were on track in 2019 to break even in less than 1 year. And that was driven by increased likelihood to take a loan, increased average loan size. The other components like cross-sell and loyalty and lower NPL take longer to measure. So they're most likely there, but we didn't have the time. Yeah.
Okay, this is massive, Kathleen. Let me pause for a second to acknowledge what you just said. So basically in this example, we have a bank that first developed a set of non-financial services in general for their clients. And within this program, they also develop a package for women in terms of financial and non-financial services. And in both situations, breaking even wasn't a problem at all. So 2 years for the overall non-financial services package and less than a year for the women, non-financial services and financial services package. This is amazing, really.
That's right.
Yes. So of course, now we want to know the recipe. So that was going to be my next question. So what does it take to design a program that has high chances of success like this example you just gave us?
Yeah, sure. So the first is understanding the program objectives, and whether it's CSR, whether it's business, deciding what you want to achieve. So it could be increasing your customer base, it could be strengthening your brand, it could be increased loan revenue, loyalty, but really being very clear about what it is you're trying to get out of this. Then once we have that, the first step is to, and I'll go through each of these one by one, but tailoring the offer to the needs of different segments, providing that integrated one-stop experience, making sure to build institutional alignment. So making sure that what the C-level champions are saying is reinforced in the incentives and the balanced scorecard of frontline staff, and that the other components are in place, like training, to make all of it come together. And then integrating measurement. So building measurement in from the very beginning, starting with the baseline and deciding what to measure and how to measure. So in terms of tailoring the proposition, so what we've seen is that banks are beginning to move away from this one size fits all. So for many years, we would see that, SMEs were kind of a general segment that were treated as mini corporates, and that was pretty much it. But now we're seeing that banks are moving towards more of a tiered offering. And so, for example, that tier one are the large SMEs, like mediums, who maybe are just a step below corporates and they are quite sophisticated. Tier two are SMEs, smaller SMEs, the kind of general, less sophisticated SME segment. And then tier three could be micro. And the percentage of women, the proportion of women changes, right? So within micro, it's usually 30% upwards of those clients might be women. Tier two, it's 20 to 30, and tier one, it could be as little as 5% or as many as 20, but the proportion of women shrinks the higher up the pyramid we go.
Right. So what you're saying, excuse me, just to really get it right, what you're saying is that the first step is to first have a segmentation that allows to understand better who we are dealing with and which categories they are. So it could be micro or micro, as it's called in some institutions. Then upper micro or lower SME, medium, etc. So what we are saying is start by having clear categories, and then you can tailor your offer, right?
That's right. And to give you an example, I don't have annual turnover, business turnover amounts here because it really varies from country to country, right? And from banks to microfinance, like it will really vary. But as an example is that, tier one, these are some common differences. So tier one are often companies, they're registered companies, whereas tier two might be family owned, they might be partnerships or even sole proprietorships. Tier one are in high profit sectors like mining, manufacturing, IT. Tier two are trade, service sector related. Tier one has formal structures and processes. So they have in-house accounting, in-house HR, sales, those kinds of divisions of roles. And tier two might kind of be doing it all themselves with the help of an outside accountant that helps them once a month, that kind of thing. And even in terms of banking relationships, like, tier one's multi-banked, they're not mixing business and personal. Tier two is banked, but it might be mixed. They might be using the same account for both. And then tier two is doing their transactions in cash. So they might have a POS machine, but even with their vendors, as well as their clients, most transactions are still happening in cash, which is not the case for tier one. So the sophistication is different and the needs of each kind of can differ. So we don't have to segment, super finely. We can just say these are two very different profiles and how do their needs differ.
Right, understood. Thank you.
So for example,
if you allow me, I just wanted to tell our audience, do post your questions if you have any already in the chat. We'll be collecting them and then answering them as we are moving towards the end of the presentation. So don't hesitate, use the chat box for this. Thank you.
Yeah. So in terms of, how to think about tailoring, so tier one is really, that full service banking relationship. They have one person they can call for all of their needs. And in terms of their non-financial services needs, it's really more tailored advisory. They might need coaching. They might have specific goals about expanding to certain markets, specific types of networking in terms of who to meet. And so it's very tailored. And women-led SMEs in this tier, they're a small group in this elite pool. So for them, of course, they need the other stuff, but opportunities to put them in touch with other successful women, mentors and role models can add value and really help them continue to grow. And then tier two, we see a lot of institutions moving this tier towards direct banking. So self-service, digital where possible, relationship management might be a pool of people, may not be dedicated. And in terms of the non-financial service offers that they need, it's really that one-stop access. So tier two SMEs and MSMEs are often, they have a very fragmented experience. So they might have a loan from an MFI, a bank, an account, a business account in a bank. They might be working with a fintech. They don't know where to look for any kind of coaching and they're not sure they would pay for it. So they're hunting around for the right solutions. So anything that can be done to kind of bring these things together, these offers together, adds value. And then also this is the segment that can benefit from financial management software. So accounting packages, those the zeros and the sages and, the packages that are, doing very well in many countries that can take that burden, relieve that burden from them. And then networking events tailored by sector or value chain. On top of that, women-led SMEs can benefit from all of that, but this is where they need help with financial literacy. How much money should I be asking for? How much can I manage? How do I get it together? Like, how do I pull together what I need to present my case to a bank? Soft skills. How does she present herself as a leader? How does she, build that confidence as a business leader? and then access to networking, mentors, role models. So these are kind of the differences in terms of how to think about what an offer might look like for different tiers, and then where the tailored components for women may come in as well. Then we have this one-stop experience, and that will differ. Some markets are moving very heavily towards digital. If we can offer the one-stop experience mainly through digital, but with a human touch that's available when required and when requested, that's certainly valuable. But ways also to think about it are in terms of how can we have, if we're offering business management technology, if we're putting her in touch with a marketplace platform. So in some markets it's Jumia, in some it's Amazon, those big places where you can buy anything. Putting her in touch with a platform, offering the tailored financing for platform vendors that many banks are starting to offer, and then also offering e-commerce education, so how to really do well in this segment. So all of those things together under one offer means that clients don't have to hunt and look for, how to piece this together themselves. In terms of the educational pieces that I've been mentioning about, business management and, some of the trainings that would be useful, blended learning approaches where majority of the sessions take place via webinar or, Zoom calls, virtual calls with some face-to-face can also be quite useful so that they can be accessed, at a convenient time by participants, but then there's also the benefit of bringing together that face-to-face interaction and learning from the coaches. So these are some examples of how to bring kind of multiple offers together under one umbrella. And the umbrella could be through the relationship officer, it could be through an app, it could be through a combination of the two. But the point is that the offer is coming to the clients versus the other way around. Okay, then institutional alignment. So here it's critical to communicate the program as a strategic priority throughout the organizations. So appoint a C-level champion who communicates the program and the performance, like how well it's doing regularly in staff meetings, reiterates its performance. Dedicating a small team to manage non-financial services. So develop programming that aligns with the strategy. That team can also coordinate with frontline staff to communicate and also help with implementation. Training staff on why and how to serve women. So kind of what's in it for frontline staff. Are there incentives for them? Can they deepen their relationships? Can their portfolios grow? Like what's the benefit to them of embracing this? And then tying their objectives not only to financial targets, but to non-financial services targets, so NFS targets as well. So making that balanced scorecard kind of really be a motivator. And then of course, determining whether to charge a fee for non-financial services. So these are the kind of the key components, but really making sure that communication is flowing consistently through the organization and that incentives and KPIs are there to make sure that it's implemented consistently.
Right.
Yeah. And then measuring. So we mentioned upfront that determining the program objectives at the outset is really step one, most critical. You could be looking for client growth through branding. You could be looking for increased revenue. You could be looking to improve retention, deepen loyalty, lower risk. And even, these objectives often can determine whether you charge. If you're looking to build your brand and you can think of non-financial services as a marketing spend, that can certainly work very well. If your objectives are a little bit different and you have a strong value proposition, then you may be able to charge for a business club if they're all under kind of that type of umbrella. So one is determining the objectives. Then we have, the right KPIs. So what's really needed to measure? What can be measured? What can be measured routinely by the team? So pick things that are doable, which, because these are not always easy to identify non-financial services participants within the pool of SMEs and then split those by gender. It's hard. It's not always, so to really deciding what makes sense. And I'll pause for a moment too to see if there's anything coming in from Edwige, but I'll take us through a sample framework, kind of a benefit cost framework to think about how to consider the benefits, what to measure, and how to measure. Should I continue, Edwige, or are there?
I just want to say I love the way you broke it down, Kathleen, into 4 steps. Step 1, tailor the proposition to the needs and profiles of different segments. And then obviously it means that in terms of granularity of the analysis, even for legal entity, it's important to be able to collect track and analyze gender disaggregated data. So it does require a little bit of, changes in the way customer onboarding, for example, is done. And then you mentioned step 2, providing and integrated one-stop experience for financial and non-financial services. Step 3, build institutional alignment. This is, I guess, one of the most important elements, even from the onset on, because the strategy is only going to be credible if at senior level it's embraced and communicated as such, both internally and externally. And then step 4, the measurement. So I really love this 4-step approach. It's easy to remember. And so I'm handing back over to you for some more example on benefit cost framework. And also, before I hand over to you, I wanted to thank, I think it's Efe Hussein that made a comment about offering partnerships on non-financial services and lifestyle products. I think it's in Nigeria, and working with over 2 million active women in Nigeria. This shows, I think, that banks and financial institutions should actually seek partnerships with business development services providers and such organizations. So yeah, thanks Efe for this comment. Kathleen, you want to take over?
Yes, thank you for that. And so a big part of this conference is the networking. So do reach out to Efe if you have a potential need. That's great. So just to kind of take us through the measurement piece, how do we find that ROI? I'll take us through an example of what we call a benefit cost framework. And I don't call it a cost benefit framework because the immediate thought when we think of things like non-financial services is that it's a cost center. It's not a business driver. So prefer to start with the benefits. So starting with what we want to get out of it, determining what those KPIs can be, what's trackable, and then subtracting out the costs. So for example, we have here one benefit may be improved client growth. It's what you're looking for from non-financial services. And so sex disaggregated KPIs to consider could be total number of participants in a portfolio, total number of NFS participants, changes in those numbers, over time. And then the program costs could be the cost of, if it's client growth, it could be the cost of, the programs that you're running. It could also be the cost of any digital platforms, those kinds of things. Sorry, my screen just went out for a second. So I'm just, excuse me one moment here. Yeah, so another benefit could be improved interest and non-interest income. So of course, measuring, interest income from loans, measuring loan portfolio size by gender and by segment, measuring changes to those to the portfolio. So these are kind of some of the very basic things that can be measured on a sex disaggregated basis. And once it's identified kind of what to measure and how to do that routinely, then it's much more easy to see sort of what the benefits might be. And then a couple of other examples. So improved customer retention and loyalty. So number of inactive accounts, an NPS score, the net promoter score, average tenure of accounts. So, average number of years that customers are active, that would be a longer term measure, those kinds of things. And then lower portfolio risk. So NPL, that's the easiest, kind of the most straightforward that I think every institution measures, but making sure you're getting that by, not just by segment, but also by gender within the segment. So sex disaggregated data. And then subtracting out the program costs, whatever they may be for your non-financial services. And so capital expenditures and operating expenditures. So capital expenditures, for example, could be proprietary digital tools that are developed in-house, development of staff trainings on gender and integration of non-financial services into the sales model. Those are examples of capital expenditures. And then operational expenditures could be the events, the networking events, the ongoing training, any digital tools that you buy, white label, kind of off the shelf and offer, those kinds of things. So this is an example of one way to consider kind of how to track the benefits and the costs, just to try to identify the ROI of a non-financial services offer. And I'll close here with just a point on the challenges of measuring. So it's not easy. So linking those KPIs to gender and then also linking them to non-financial services can be a challenge. So figuring out, having the system be able to figure out who's in the business club, for example, who's attending certain events. It's often a CRM, a customer relationship management system can help a great deal, particularly when certain types of data are distributed across multiple systems within an organization. There might be loan data someplace, deposit data someplace else. So kind of figuring out really what works well for the institution. And then identifying the 2 or 3 KPIs that are best able to show whether the program's meeting objectives. You don't need to measure everything. Less can be more, especially if that means that fewer KPIs can be routinely measured. It's also important to define women-led MSME. So could be whether she owns the business, it could be whether she is a key shareholder in the business, but really defining what that is and implementing the process for capturing the sex of SMEs. So it could be at account opening when the shareholders are listed that the gender is captured, but finding a way to capture that at account opening is critical because, or that's a lot easier than having to reverse engineer it and go back and fill it in later. So finding a way to capture that among SMEs. And then thinking about IT infrastructure, capacity, and what can be tracked. Establishing a baseline. So where are we starting? So you've got your objectives, or maybe even before you have the objectives, you take a look at where you are today to determine the objectives. So who's in your portfolio? What are they using? How are they using it? And then implementing that ongoing performance monitoring for frontline staff. So not just giving them one training and saying that's it, but making this part of kind of their routine training, routine monitoring, and their own KPIs. So I've just kind of shared an awful lot in about an hour. So I'm going to stop here and thank you all for joining us today. And I will ask Edwige to share any questions that are coming in from the audience. We have about 25 minutes for questions. So looking forward to hearing those.
Yes, we do. Thank you very much, Kathleen, for this very comprehensive framework, let's say, that gives us a fair idea of which direction to take for those in our audience that were thinking about developing or updating maybe a gender strategy. Maybe the key elements that were very powerful, which you mentioned, one of those is the fact that making sure that you have a value proposition for women and tailoring your offer to their needs has as let's say, secondary effect that you actually might make more clients happier because you are learning a lot of interesting things in the journey, even in terms of better categorizing clients and more and having a closer relationship with them and being able to better adjust your needs to them. Once you do that for women, you can do it for many different subcategories of clients. So the journey itself is worth it. We understand from your presentation. We also keep in mind that even though the whole thing feels and looks expensive in terms of upfront investment, maybe there's a way to do it in a modular way. It doesn't it's not necessary to do everything at once. Some things are actually free. I'm thinking about what you said about having role models and how important it is for women entrepreneurs. Generally, it's not very complicated to show success stories and to share them. And then as and when you are continuing, you might be adding other elements to your strategy. So you don't need to do everything at once. I will be looking at the questions. So we have one question from Suzanne. Thank you very much, Suzanne, for asking this question. Kathleen, how do you track your development outcomes? Do you procure the process to a third party, or you have specific tools to collect data? And if yes, what are they? So I see two parts of this. How do you track your development outcome? And the aspect on whether it's better to outsource or there are tools that can be used internally.
So that's an interesting question. I'm not sure I'm clear. So development outcomes could be impact on the businesses, or it could be the business case. So if it's the business case, I would say that could be certainly be done in-house by the business teams. And in terms of if there's a CSR approach, that would be tracked by, I don't tend to take that direction. So, there are ways to track development outcomes, but they usually require, I would say, surveys of clients and, sometimes tracking of clients that would typically be third party. I think that because it can be somewhat labor intensive, but it's also quite valuable. I think often that kind of stuff would be outsourced, as it tends to be kind of research focused and, usually outsourced to a third party. Yeah.
So is it a good idea in terms of having a clear baseline? Is it a good idea to have a customer survey before launching the strategy and then going back to the clients on a regular basis?
Sure. Yeah. And there could be. So for example, one critical piece is upfront research. So understanding what the clients need. So you start with the data in your portfolio, and then if you can do client research to understand kind of what are they looking for? How do they want to be served? How do they want to be served by this institution? And that can be done. Yes, you can pay an outside agency. You can also develop a survey and have your call center deliver it. It could be a combination of the two. So there are ways to do it without spending enormous amounts of money. Even just listening to frontline staff and kind of having them or providing a feedback loop for clients, like saying, how do you want to be served? Answer these 5 questions and just put it out there, in however the best way is to reach them via SMS or some other way.
Understood.
Yeah.
Another question, we are not quite done yet. So how can we explain that despite having a large base of women in their clientele, MFIs in West Africa usually don't have a specific offer for women? I think this goes back to a question we raised at the beginning. So what's your take on that? Yeah,
exactly. So if you have a large female client base, that's terrific. Are there more people you could be serving? So do they have additional needs? And so I would say that if there are a couple of key financial products, loan types that serve them well, that's terrific. But then do they have collateral constraints? Are there women with businesses in your portfolio that could use higher loans, but there's nothing in place to offer those loans? Is there opportunity to move towards a cash flow based appraisal process for those women who've grown with you and are now kind of outgrowing the current loan size, or for new women who are caught in the middle, unable to access credit, even though they have the business to be able to cover it. Also, the non-financial services piece, I do understand that a number of MFIs in West Africa offer business trainings and those kinds of things. That's terrific. And so figuring out if what you're offering is how that's been received, if there's more you can do, or maybe it's tailoring the financial piece to complement the non-financial piece. It's really talking to customers, understanding what they need and how to deliver it. But I happen to know that financial inclusion in West Africa is not 50-50, and it's not 100% of the population either. So there's certainly room to continue to grow, and that's a great opportunity.
Right, indeed. So I think it starts by being aware of the fact that even if statistics show that we have a lot of clients in our clientele as a financial institutions, in terms of qualitative experience, it's important to go to them and, inquire a little bit about whether their needs are satisfied. Thank you for that. We have another question. Access to financing for rural women in DRC is very limited due to a number of factors, in particular, the absence of road infrastructure, communication, technology, literacy levels, access to land, etc. How can we strengthen the financial inclusion for women despite all those points and improve the rate of access to financial services?
Abish, you are an expert on DRC. You may have more specific knowledge about the environment there than I do. Would you want to take this question?
Well, let me try, and then I'll welcome your addition. What I would say about DRC is indeed, and it's not just for DRC, it's also for several countries in Africa. Infrastructure in general is not very good, and that makes the work of financial institutions even harder. To a certain degree, technology can help in areas where you do have certain infrastructure, but we will be for a few more years in a situation where probably the majority does not have access. However, what I would add to that is even for those that are in urban areas and rural areas that have access to mobile phone technology, for example, I do not think that financial institutions have yet covered the need. So I would say it makes sense to first start with, the obvious, what is sometimes called the low-hanging fruits, even though it's not hanging so low yet, before aiming at the wider countryside. So that's the way I would approach it with the gender strategy. First, cover where you are and where you can, and then you can move to the next stage as and when infrastructure is getting better.
Yeah, and as digital networks and as the network improves, perhaps trying to shift clients to digital tools where possible and where relevant. So if they're able to pay, if they're able to not have to travel, if they're able to transact remotely, and then also access potentially, depending on the cost of data and those kinds of things, the cost of accessing some non-financial components as well, that could help. Yeah.
And there was an element of lack of collateral. I think you mentioned as well that, mortgage is not necessarily the only way in terms of lending approach, and there are different ways of approaching the needs of the unbanked. Do you want to comment on that?
Yeah, I mean, so cash flow appraisals, well, there are a couple of different things, right? One is cash flow. One is what some institutions do, microfinance institutions do, is increase their flexibility around the types of collateral. So movable collateral, chatels, invoice discounting for slightly larger customers. So there could be different ways to approach collateral to have that security. And then there's also, the cash flow based appraisal, which requires a fair amount of training. It requires a fair amount of monitoring because that requires the loan officers and the credit committees and really the institution to understand the businesses and to really understand the sector and how those cash flows work and, when there might be risk and when the risk is low. But it can pay off because we've seen it. I have Lead Foundation, the microfinance institution in Cairo, spent probably 2 years getting their cash flow based appraisal really into the mainstream routine. And the result was that they grew their portfolio by 40% clients and it really increased access to women on individual lending. KCB in Kenya, the commercial bank, did the same thing. And, for their MSME portfolio and their portfolio at risk for both institutions, once the pilots were finished and once it was really up and running, was below 1%. So it can be a win in terms of growing revenue, growing your client base. It just does take some effort, to be honest. It's not a quick solution. It's something that takes a fair amount of focus and monitoring. Yeah.
Right, understood. Maybe I can add to this. I once encountered the case of a microfinance institution that decided to actually create a loan product to help women entrepreneurs buy assets. So, since everybody was always complaining that entrepreneurs do not have assets that can be used as collateral, they had over a certain period of time this offer. Of course, it's not for everyone. It requires a more detailed analysis of who can afford that, and also longer maturities for this type of lending. But I believe that this kind of initiative can, a few years down the road, create a pool of clients that are now becoming eligible for larger loans because they do have land.
Yeah. And I just see a comment coming in from Suzanne, which is right, dead on. It's a good point. So in terms of the question on access to rural populations and financial inclusion and gender parity is not a one stakeholder initiative, right? So it requires governments, it requires the public and the private sector, it requires multiple stakeholders. So Suzanne has made the comment, it's very true, that another approach is advocacy. So advocating to local authorities and government bodies for promotion of these areas, for strengthening infrastructure, for kind of supporting the initiative and supporting both gender parity and the infrastructure needed to support financial inclusion. Thank you for that, Suzanne.
Because that was part of a previous question, maybe I go back to this point on the importance of financial literacy. One of our participants raised the fact that they noticed that the majority of their clients has a lower level of education, and he was wondering how important it is to integrate different levels of financial literacy programs into the gender strategy.
Mm-hmm.
Do you have examples?
It can be quite important. I mean, we're leading some research now, actually in West Africa, and the feedback coming in from clients is once you move from the group, like when you're in group lending, the training is there. It's mandatory. You go for the training, you learn everything, and then you get the loan. When you graduate to individual lending, that all goes away. So suddenly you have a bigger loan, you're not sure how to manage it. And so I would say definitely there's, whether it's mandatory or not, I'm not saying it has to be mandatory, but offering those, whether it's a webinar, whether it's however she accesses it, whether it's a one-on-one, whether it's a training, what's needed, how to think about how much to access, how to think about, business management. If a lot of times we see entrepreneurs, both women and men, but more often women, who write down all of their expenses and they write down all of their sales, but they don't link them. They don't know what to do with the information. They just know they should write it down. So teaching financial literacy, both in terms of how to access finance and how much, but also how to tell when you're making a profit or a loss, how to know if someone's stealing your inventory or stock. By really tracking that, it can be very valuable. And I would certainly integrate it into an offer. And it doesn't have to be mandatory. It all depends on the institution and the client profile. But those are the kinds of things that we hear a lot of requests for in research. And also general business management. How do I grow? How do I keep it running? Times are uncertain. How do I think about cash flow? Cash flow can be is a tough thing to manage. And so what are some tips and tricks about managing cash flow? Those kinds of things. Yeah.
Right. We understand that the same way in group lending, there's a key component of training. The same way individual borrowers, when they graduate from the group loans or when they come for individual loans, there will be a time frame where they need to learn from their loan officers or their business client service, business advisor, however we call it. They will need to rely on them for advice and for guidance. This is very important and very key. So again, it doesn't have to be an expensive program rolled out separate from the day-to-day business. It can be integrated in the way loan officers, business client advisors work on a daily basis.
That's right. And the point about not doing everything at once is a very good one. Often it works well to start small and pilot, right? So start something, start with the lowest hanging fruit, the things that you think clients will like the most, and start there and pilot and measure and then get some feedback. And then, so take the time to get it right, because it's hard to reel something back in if it rolls out network wide, and it turns out. So it's often worth it to spend some time piloting, starting small. You don't have to spend a great deal in the beginning, just see what works and what makes the most sense for your institution.
All right. I think we've had a very lively session with quite some interesting questions. In case there are some more questions, we still have a couple of minutes left. Don't hesitate to send your questions. Maybe as a reminder, our slides will be available as well as the replay on the program website, accessible to all participants. And also we will be having a series of webinars after the conference. So after this session, please don't leave. There will be a poll in order for you to be able to share key topics you would want to have webinars or other learning sessions on, so that we can take that into consideration in the program. And we will also be having the closing session. For the next few minutes, in case you have additional questions or comments, they are more than welcome. We do have a question coming from Kafui Sachivi Sosu. Thank you very much, Kafui. There's a great number of women that don't have an identity document. Meanwhile, this is very important to start the relationship with a financial institution. What can you propose in terms of solution? Thank you very much for this question. Kathleen,
yes,
do you have advice?
Yes, and we have seen microfinance institutions that help with registration. So as part of their outreach to potential clients, certainly it can be, particularly if registration and ID is required for any kind of access, as it is in most countries, help clients with registration for their ID. There are also, I know in some markets, formal ID is not always required, but a letter from the village head or some other validation of their identity can also be accepted. Of course, that varies depending on the laws and the regulations in a given market. But helping clients access an ID is a great step. And then also for clients, if there are benefits to formalize a business, helping clients register their business also is something that institutions can certainly do, because then, it opens up possibilities for a deeper relationship with the client.
Right, great example. I know of an institution that actually also rolled out the program to help clients with identity documents, to help clients with registration of their companies as part of their corporate social responsibility program. So it makes sense that the corporate social responsibility program actually helps also solve problems that clients have that are barriers to accessing financial services.
Yeah.
All right. We still have a bit of time for one or two more questions. As a reminder, our slides and this, as well as the slides of all slides of all sessions, will be available on the website of the program, www.msmeta.eu, and you will have access to the replay as well. And right after this session, please don't leave. We will be having a poll for you to be able to share the topics you would want training or webinars, and we will also be having the closing session.
Yes.
So in case there is no other question from any side, then we might be having closing remarks from you, Kathleen.
Yes, thank you. So I would like to thank everyone for their attendance and participation today. And I hope that, this kind of gave a new perspective on how to think about serving women and how to think about what could be in it for a bank or an MFI. We will give about 5 minutes back to you right now. So we'll close the session, and keep in mind that in about 10 minutes, we'll be going into the final closing session of the conference. So I hope you all had a really enjoyable kind of 2 days and learned a lot, met some new contacts, and looking forward to staying in touch with those of you who've reached out. Thank you.
Thank you, Kathleen, for this amazing session, and I'm looking forward to more with you. Have a great end of the